You're welcome to this channel. We want to look at IAS1 presentation of financial statements. In the previous video, we looked at the conceptual framework, which I said is the basis or the bedrock of IFRS. So today we want to look at IAS1 in detail, starting from the objective, all right, of IAS1. This standard prescribes the basis for presentation of general purpose financial statements to ensure comparability both with the entity's financial statement of previous periods and with the financial statement of other entities. All right, in the conceptual framework, I explain what we mean by general purpose. So it is not a specialized financial statement. And we also talk about the characteristics, quantitative characteristics of financial reports. All right, and we mention comparability as one of the qualitative characteristics. So we should be able to compare the financial statements of this year with last year. We should be able to compare the financial statements of company A with company B in the same industry. All right, so basically, IAS1 is a guide for us. It's a standard for preparers of financial statements on how to prepare the financial statement, how to present financial information. Okay, the scope of IAS1, an entity shall apply this standard in preparing and presenting general purpose financial statement in accordance with IFRS. Okay, purpose of financial statements. Financial statements are a structural representation of the financial position and financial performance of an entity. Remember, in the conceptual framework, I talk about the agency theory. Basically, you have the directors as the agents of the principals, that is, the agents of the shareholders. So at the end of the accounting period, the agents have to prepare a financial report to the stakeholders, including the shareholders, on the financial performance of the organization. So give us details of the financial position and give us details of the financial performance of the business. Okay, so we are going to have information about the assets of the organization. Okay, resources controlled by that entity as a result of past events. Give us information about the liabilities. Give us information about equity, owner's interest. Give us information about income and expenses, including gains and losses. Give us information about contributions by and distributions to owners in their capacity as owners. Okay. Then give us information about the cash flows. Okay, so all these are information you expect in a typical financial statement. Complete set of financial statements according to IAS1 should include a statement of financial position as at the end of the period. That is what we used to call balance sheet. Okay, so remember our accounting equation. So you are going to have assets, you're going to have liability, you're going to have the capital. All right, in the statement of financial position, then a statement of profit or loss and other comprehensive income for that period, a statement of changes in equity for the period, a statement of cash flows for the period, then of course notes comprising material accounting policy information and other explanatory information, then comparative information in respect of the preceding period as specified in paragraph 38 and 38A. So give us information about what happened in the previous period. You know, I talked about that when I was talking about comparability in the former video. So IAS1 states that, you know, in a set of financial statements should have at least 2 periods so that we can compare the trend over those 2 periods. Okay, a statement of financial position as at the beginning of the preceding period when an entity applies an accounting policy retrospectively or makes a retrospective restatement of items in its financial statement, or when it reclassify items in its financial statement in accordance with paragraphs 48 to 40D. Okay, so give us if you change your accounting policy according to IAS 8, which I will look at in another video. So you have to provide a statement of financial position as at the beginning of the earlier period. Okay, note that an entity may use titles for the statements other than those used in this standard. For example, an entity may use the title Statement of Comprehensive Income instead of Statement of Profit or Loss and other comprehensive income. So IAS 1 gives you that liberty as per the vocabularies or the nomenclature. Okay, it also gives you opportunity to present your income statement, all right, either as a single statement of profit or loss and other comprehensive income, all right, or you present it separately in two sections. So you have the statement of profit or loss in one section, then the statement of other comprehensive income in another section. So IAS 1 gives you that opportunity or that liberty on how to present your income statement. Okay, an entity shall present with equal prominence all of the financial statements in a complete set of financial statements. So you are not to hype one section of the financial statement above another section. That is what that paragraph is saying. Okay, fair representation and compliance with IFRS. Financial statements shall present fairly the financial position, financial performance, and cash flow of an entity. Okay, and the standard also went ahead to say the application of IFRS with additional disclosure when necessary is presumed to result in financial statement that achieve a fair presentation. So according to this standard, if you actually prepare your financial statement in line with IFRS, definitely you are going to have a fair presentation. Now look at this. In the extremely rare circumstances in which management concludes that compliance with a requirement in an IFRS will be so misleading that it will conflict with the objective of financial statement set out in the conceptual framework, the entity shall depart from that requirement in the manner set out in paragraph 20 if the relevant regulatory framework requires or otherwise does not prohibit such a departure. So there is an what we can call like an escape route here. So if you discover that complying with IFRS will make the financial statement to be misleading, then you should not comply with IFRS. Okay. Of course, we expect that instance to be very, very rare. Okay. In one area where one of these rare areas where this can happen is when IFRS conflicts with your national law. Maybe there's a section, a paragraph in IFRS that is in conflict. A section in IFRS is a conflict with the national law. We all know that national law supersedes international standards. Okay, so in a situation like that, you have to follow the national law and drop IFRS. Okay, but of course, that is expected to be an exception rather than the norm. Okay, so when an entity departs from a requirement of an IFRS in accordance with paragraph 19, it shall disclose A, the management has concluded that the financial statements present fairly the entity's financial position, financial performance, and cash flows, that it has complied with applicable IFRS except that it has departed from a particular requirement to achieve a fair presentation. C, the title of the IFRS from which the entity has departed, the nature of the departure, including the treatment that the IFRS will require, the reason why that treatment will be so misleading in the circumstance. 6, that it will conflict with the objective of financial statements set out in the conceptual framework and the treatment adopted. So you cannot just say we are not going to comply with IFRS because no, you have to justify. You just have to give full details. All right, you have to disclose full disclosures while you are departing from IFRS. Going concern. Of course, we talk about going concern under conceptual framework. Okay, so every financial statement prepared in accordance with IFRS is prepared, with that assumption, that going concern assumption, that the business will continue into the foreseeable future. All right, then accrual basis of accounting. We've already talked about accrual basis in the conceptual framework. So what that means is that accounting transactions are recorded in the period that they occur, not necessarily when they are paid for. Okay, so you don't wait until you have exchange of cash, okay, or you've paid for a particular assets, okay, before you record it. So you recognize transactions the moment they have occurred, not when there is an exchange of cash. So that's what we mean by accrual basis. All right. Materiality and aggregation. An entity shall present separately each material class of similar items. An entity shall present separately items of dissimilar nature or function unless they are immaterial. So you have to be very careful so that you don't bug up the financial records with unnecessary information. All right, you just overload. So as much as possible, all right, recognize only material transactions. All right, if a line item is not individually material, aggregate it with other items. All right, either in those statements or in the notes. So we want the financial statement to reflect only material information. Offsetting. This is also very important. An entity shall not offset assets and liabilities or income and expenses unless required or permitted by an IFRS. I talked about that also in a conceptual framework. All right. So you have as a business, another business is owing you. All right. So that is basically a current current asset. Okay. Then you are also owing that same company, okay, as a current liability. So what this is saying is that you cannot add everything together. So let us find the net position. You cannot, okay, because you will be confusing us. We don't have the history of the full breakdown of the transactions, will not exactly know what happened. So show the liability part in the current liability, show the asset aspect of the current assets. Okay, so record them separately in those two different sections. So we are not allowed to offset unless it is specifically permitted by an IFRS. Then structure and contents of the financial statements. An entity shall clearly identify each financial statement and the notes. Okay. In addition, an entity shall display the following information prominently and repeat it when necessary for the information presented to be understandable. Remember, we said understandability, all right, is also part of the qualitative characteristics of information. So let us know the name of the reporting entity or other means of identification and any change in that information from the end of the preceding reporting period. So you cannot give us a financial statement that does not show the name of the company or the business that you are reporting for. Number B, whether the financial statement of individual entity or of a group of entities. So is it for an individual entity or is it a group account? C, the date of the end of the reporting period or the period covered by the set of financial statement or notes. So periodicity, let us know the period covered by the financial statements. The presentation currency, so as defined in IAS 21. So that is, what currency are we using to present the financial statement? Is it Naira, is it cedis, is it dollars, is it pound sterling? Let us know. Then the level of rounding used in presenting amounts in the financial statement. And of course, you have to use that consistently throughout the financial statement. Okay, so let's look at the statement of financial position. The statement of financial position shall include the line items that present the following amounts: property, plant, and equipment. So they are giving us ideas of what you should have in the statement of financial position. So your property, plant, and equipment, investment property, all right, intangible assets, financial assets, portfolio of contracts within the scope of IFRS 17 that are assets disaggregated as required by paragraph 78 of IFRS 17. Investments accounted for using the equity method. Biological assets within the scope of IAS 41, agriculture. Inventories, IAS 2. Trade and other receivables, cash and cash equivalents. The total of assets classified as held for sale and assets included in disposal groups classified as held for sale in accordance with IFRS 5. Non-current assets, held for sale, and discontinued operations. Trade and other payables, provisions, financial liabilities, portfolios of contracts within the scope of IFRS 17 that are liabilities disaggregated as required by paragraph 78 of IFRS 17. Liabilities and assets for current tax as defined in IAS 12 income taxes, deferred tax liabilities and deferred tax assets as defined in IAS 12. Liabilities included in disposal groups classified as held for sale in accordance with IFRS 5, non-controlling interest presented within equity, and issued capital and reserves attributable to owners of the parents. So these are items which IAS 1 is actually recommending for us to have in a statement of financial position. All right, IAS 1 also gave us information about current and non-current distinction. You know, under our old GAAP, we used to have, what we call fixed assets in those days. When I was studying to be a chartered accountant, we were using in ICAN class those days, we say fixed assets. You know, and one of the wonderful things that IFRS has done is to question that terminology, fixed assets, all right? Because you're assuming that the asset is located on one spot. All right, so does it make sense to call a motor vehicle a fixed asset? It does not make sense, right? Even generators that are kind of stationary, they are movable, okay? You can move generators. So, so it's not really, doesn't really make sense to call it a fixed asset. So instead of fixed asset, they call it non-current assets, okay? So an entity shall present current and non-current assets and current and non-current liabilities. All right, so it also went ahead to define what is current asset and what is the current liability. All right, an entity shall classify an asset as current when it expects to realize the asset or intend to sell or consume it in its normal operating cycle, usually within a year. Okay, so you want to realize the assets. Okay, for example, inventory. Okay, so you are holding inventory, okay, in your normal operating cycle. Okay, you want to dispose it in your normal operating cycle, or cash, for example. Okay, so cash will be held as, you know, designated as a current asset. So whatever assets that you expect to realize within the operating cycle of that particular entity is termed as a current asset. Okay, it holds the asset primarily for the purpose of trading. All right, so if that asset is being held for trading, okay, then you can also tag it as current assets. Okay, it expects to realize the asset within 12 months after the reporting period. or the asset is a cash or a cash equivalent as defined in IAS 7. All right, unless the asset is restricted from being exchanged or used to settle a liability for at least 12 months after the reporting period. So these are the four classifications you can use to determine whether an asset is a current asset or not. Now, if any asset falls into either A, B, C, or D, it's a current asset. Now look at that last line. An entity shall classify all other assets as non-current. So actually in IAS 1, non-current asset does not really have a definition. We can only just you can imply the definition of a non-current asset, but it's not as explicitly stated like we have in as we have for current assets. Okay, so once an asset does not fit into the definition or classification of a current asset, IAS 1 says automatically push it to non-current asset classification. Okay, current liabilities. An entity shall classify a liability as current when it expects to settle the liability in its normal operating cycle. All right, so your trade payables, for example, okay, you want to, you are going to settle within your normal operating cycle. Okay, it owes the liability primarily for the purpose of trading. Okay, the liability is due to be settled within 12 months after the reporting period. Then D does not have the right at the end of the reporting period to defer settlement of the liability for at least 12 months after the reporting period. So once it fits into either A, B, C, or D, is a current liability. Now, if it does not fit into either A, B, C, or D, and it's a liability, then automatically it is non-current. So that's how IAS 1 defines non-current liability. An entity shall classify all other liabilities as non-current. So you can see an example of a statement of financial position. All right, like we said, you need to show us the name. You must identify the name. You must identify the period that is being covered. Okay, so you have assets, and of course the assets are broken down to non-current assets, formerly known as fixed assets. All right, so we have land and buildings and machinery. Then you have current assets. All right, you have inventories, formerly called stock in those days, but in IFRS, okay, because stocks is confusing. Okay, when you hear stocks in accounting, you are thinking of shares. Okay, you're thinking of shares, so it's very confusing. So that's why IFRS does not encourage you to use stocks when describing inventory. So IAS 2 has clearly settled that inventory, we should be using the terminology inventory instead of stock. Then account receivable, all right, also it doesn't look nice. Customers that are helping you to make money, okay, and they bought on credits that have increased your turnover, why should you call them debtors? Okay, we used to call them debtors those days, okay, but now according to IFRS, so they find a very good name, more befitting name for your customers. So instead of calling them debtors, they call them account receivable. So your balances that you are still waiting to get to convert to cash, call it account receivables, not debtors. All right, then of course cash. Okay, so we can add our current assets with our non-current assets to our total assets. Then of course the liability aspect, you're going to have the current liabilities like the account payable, bank overdrafts. Okay, the non-current liabilities like a long-term loan. All right, so we can add the current liabilities and the non-current liabilities together to get our total liabilities. Okay, then you can find our net assets, total asset minus total liability. So we can find our net assets to be this. Then we can look at our shareholders' equity. So share capital is noted. The profit and loss account reserve, that is the retained earnings. Okay, then we add that together, we get total shareholders' equity, which of course must balance with our net assets. So this is a very simplified statement of financial position, and is very, very much in line with IAS 1. Then, of course, we have to report our income for the year. Okay, we have to report our income over the period of that we are reporting. So the statement of profit or loss and other comprehensive income shall present, in addition to the profit or loss and other comprehensive income sections, profit or loss for the year, total other comprehensive income we have made, comprehensive income for the period being the total of profit or loss and other comprehensive income. Okay, an entity shall present the following items in addition to the profit or loss and other comprehensive income sections as allocation of profit or loss and other comprehensive income for the period. All right, profit or loss for the period attributable to non-controlling interest, NCI. Of course, you already know that means you are reporting for a group account, okay, consolidated accounts. All right, IAS 10. So if you are reporting for a group account, then definitely you have to show us profit or loss that is attributable to the owners of the parent organization, then the profit or loss attributable to the non-controlling interest. And of course, we have to share that according to their respective holdings in the organization. Okay, then comprehensive income for the period attributable to non-controlling interest and owners of the parent. So that is also referring to group accounts, okay, or consolidated accounts basically. So tell us the profit or loss and the comprehensive income, share it among the holding company and the NCI, the non-controlling interest. Okay, information to be presented in the profit or loss section or the statement of profit or loss. In addition to items required by other IFRS, the profit or loss section or the statement of profit or loss shall include line items that present the following amounts for the period. Right, show us the revenue. Okay, in your income statement, show us revenues, present separately. Interest revenue are calculated using the effective interest method and insurance revenue. Show us clearly the revenue made by the organization. All right. Gains and losses arising from the recognition of financial assets measured at amortized cost, insurance service expenses from contracts issued within the scope of IFRS 17, income or expenses from reinsurance contract held according to IFRS 17. All right, so they are giving us more information about the revenue. So basically, IAS 1 requires you to show in your income statement the revenue made by the organization for that period. Then it must also show us the finance costs. All right, show us the finance costs for that is expensed in the year. Okay, impairment losses, insurance, finance income or expenses from contracts issued within the scope of IFRS 17, finance income or expenses from reinsurance contract held. Okay, show your income statement should show the share of the profit or loss of associates and joint ventures accounted for using the equity method. D, your income statement should show the tax expense also. So basically, this area is telling us the key information that you should show in your profit or loss. Show us the revenue, all right, show us the finance costs, show us the share of the profit or loss of associates, all right, show us the tax expense. Key information, all right. Information to be presented in the other comprehensive income section. All right, the other comprehensive income section shall present line items for the amounts for the period of A, items of other comprehensive income, excluding amounts in paragraph 5, paragraph B, classified by nature and group into those that, in accordance with other IFRS, will not be reclassified subsequently to profit or loss. I will show you an example just now. And 2 will be reclassified subsequently to profit or loss when specific conditions are met. All right. So you see an example of a statement of other comprehensive income. All right. So you see profit for the year. All right. So we have the profit for the year. The other comprehensive income now. Okay. So items that will not be reclassified to profit or loss, items that may be reclassified subsequently to profit or loss. So that is what that section is saying. So let us look at the example of items that will not be reclassified to profit or loss. For example, gains on property re-evaluation. Okay, so if you revalue your properties in accordance with IAS 16, and there is a gain, so it will be in your other comprehensive, the gain will be in other comprehensive income. All right, investments in equity instruments, remeasurement of defined benefit pension scheme, pension plan. All right, we'll look at that under accounting for benefits. Okay, then a share of gain or other comprehensive income of associates, the income tax related to items that will not be reclassified. So all these are items that will not be reclassified to profit or loss and will be actually posted under other comprehensive income. Then we have items that may be reclassified subsequently to profit or loss. Okay, so let's look at the example: exchange differences or translating foreign operations. So we'll look at that when we get to IAS 21, cash flow hedges, income tax relating to items that may be reclassified. So these are examples of items that will be under items that may be reclassified subsequently to profit or loss. Okay, so at the end of the day, we can find our net position and find the total other comprehensive income for the year, right? So you can see that. So this is just an example of how your other comprehensive income will look like. Of course, like we said, the other comprehensive income can also be divided into 2 sections: items that will not be reclassified to profit or loss ever, the item that may be reclassified subsequent later to profit or loss. Okay, so an entity shall present an analysis of expenses recognized in profit or loss using a classification based on either their nature or their function within the entity. Okay, I will show you that now. So when you are classifying expenses, IS1 allows you to choose between classifying them according to nature or classifying them according to their function. Now, if you classify them according to nature, what does that mean? An entity aggregates expenses within profit or loss according to their nature. For example, depreciation, purchases of material, transport costs, employee benefits, and advertising costs, and does not reallocate them among functions within the entity. So you just say it as it is. So look at a very good example. So we have our revenue, right? Other income, changes in inventory of finished goods and work in progress, raw materials and consumable use, employee benefit expense, depreciation and amortization, other expenses, total expense, profit before tax, straight. So just give it the names as it is. Call it what it is. This money, this expense is for transports. This expense is for advertising. So basically, so that is what we mean by classification by nature of expense. All right. Then we also have by function of the expense. All right, or cost of sale method. So classify them according to their function. All right. For example, distribution costs, administrative costs. So you have to group the expenses under distribution, under administration, under cost of sales, and so on. So you can see an example here. So you have your revenue, you have your cost of sale, you have your gross profits, other income, then distribution costs. So this distribution cost now we can break it down. You will see other costs under it. Then you have admin expenses also. Okay, so it's now left for the organization to make decisions. Oh, this expense is supposed to be in distribution. This expense will be under administration. All right. I want to take note of something here. This method can provide more relevant information to users than the classification of expenses by nature. But allocating costs to functions may require arbitrary allocations and involve considerable judgment. So that's what I'm trying to let you know there. So you have to make a decision. Is this a distribution cost? Is this an admin expense? So we have to be able to make such decisions. So that is one challenge with using analysis by function, expense analysis by function. Then you have statement of changes in equity. All right, basically, so we want to see the movement in our share capital. All right, we want to see the movement in our retained earnings. We want to see the movement in our reserves, okay, over the 2 periods. Okay, remember we talked about the comparability. Okay, over the 2 periods. That is basically what statement of changes in equity is all about. So the statement of changes in equity includes the following information: total comprehensive income for the period, showing separately the total amounts attributable to owners of the parents and to non-controlling interests. For each component of equity, the effect of retrospective application or retrospective restatement recognized in accordance with IAS 8. And for each component of equity, a reconciliation between the carrying amount at the beginning and the end of the period separately as a minimum, disclosing changes. All right, show us what changed. Okay, if our retained profit increased, all right, show us what changed it, what increased it. Okay, if our reserve increased, what led to the increase? If it reduced, what led to the to the decrease? Okay, so these changes could be from profit or loss, could be from other comprehensive income, could be as a result of transaction with owners in their capacity as owners. For example, you share dividends. Okay, so the statement of changes in equity should be able to capture payment of dividends. Okay. Information to be presented in the statement of changes in equity or in the notes. For each component of equity, an entity shall present either in the statement of changes in equity or in the notes an analysis of other comprehensive income by item. An entity shall present either in the statement of changes in equity or in the notes the amount of dividends recognized as distributions to owners during the period and the related amount of dividends per share. Changes in an entity's equity between the beginning and the end of the reporting period, reflecting the increase or decrease in its net assets during the period. So you can see a very good example here. So you see the share capital, you see the share premium account, the statutory reserve, general reserve, retained earnings, foreign exchange translation, adjustments, relative changes in fair value. All right, then you have the total. Okay, so this is for for a group. Okay, so you have that of the parent, so then you have that of the NCI. Okay, the non-controlling interest. Okay, so you have balance as at 31st December 2009. So you can see the opening balances there. Okay, so you have profit for the period. Of course, that one will affect only retained earnings. Okay, so you have that. Okay, then you have the total. Okay, then you have the other comprehensive income or loss for the period. Okay, so other comprehensive income, of course, you will have seen that foreign exchange translation and cumulative change in fair value, they are OC other comprehensive income elements. So definitely, so that's OCI income or loss will be shared between foreign exchange translation adjustment and cumulative changes in fair value. Okay, so then there was a rights issue in the year. Okay, there was a rights issue in the year. So you can see it's issue of share capital right issue. So you have 1,110. So that's takes our balance from 2000 in the beginning, 31st December 2009 to 30th June 2010, takes to 3,110. All right, so you can see the opening balances, then you can see the closing balances. Okay, so this is a very good example of a statement of changes in equity. So basically, it's just to show us, how our equity elements have moved, have changed in the from the time of the last reporting period to the current reporting period. So basically, show us what has changed in the share premium account, show us what has changed in the share capital account, show us what has changed in the reserve account, show us what has changed in the retained earnings, and be very, very transparent. Give us the opening balances, give us the changes, then give us the balance at the end of the year. Then, of course, you have to also prepare a statement of cash flow. We'll look at that in more details when we get to IAS 7. So cash flow information provides users of financial statement with a basis to assess the ability of the entity to generate cash and cash equivalents and the need of the entity to utilize those cash flows. Okay, so show us how the organization has been able to generate cash, how the organization have been able to use cash in the year, in the period being reported. Okay, so statement of cash flow is very important. Okay, because when you look at the financial statement, basically you look at the statement of profit or loss. Okay, what you have is an accounting profit. Okay, you have some non-cash elements in normal income statement. For example, depreciation. Okay, depreciation is not something you can it's not a cash transaction. All right, you have revenue, and part of the revenue you have credit sales. So a company may actually make a good accounting profit, but may be in trouble as regards liquidity, and that is why statement of cash flow is actually very important to show you how liquid that organization is. And of course, this may actually give you an insight also to the going concern status of that organization. Then you expect to also add the notes. So the notes shall present information about the basis of the preparation of the financial statement and the specific accounting policies used in accordance with paragraphs. Disclose the information required by IFRS that is not presented elsewhere in the financial statement, and provide information that is not presented elsewhere in the financial statement but is relevant to an understanding of any of them. So a lot of time, if you have looked at a typical financial statement before, you will see a lot of numbering. Okay, so maybe in the statement of financial position, you can just write maybe trade receivables, you write 1. So that one means go to the notes to look for 1. Then when you get to that one, you now see for more information, maybe a breakdown of that trade receivables. So they have an information for you as a user of financial statement, you will see it in that note 1. So notes are very, very important to help us to understand better what the preparer of the financial statements are trying to pass across. Okay, so this is a presentation of IAS 1. I hope you have been able to learn 1 or 2 things on IAS 1. In subsequent videos, I will be looking at IAS 2 and the other standards in IFRS. So if you have not yet subscribed to this channel, kindly subscribe to this channel so that you'll be able to get more accounting and other educational materials from this channel. Thank you.